in this reaction to a bust, we could see 30 trillion in the balance sheet, an additional 20 plus. And every central bank around the world doing something similar, just because they don't have any other tool to deal with something that's basically free-falling, not just markets free-falling, actual banking system free-falling.
This is Kaiser Johnson with Liberty in Finance, and these are the Miles Franklin Weekly Specials while supplies last. Pre-1965 mixed junk silver is just $1.99 over spot per ounce. And pre-65 half dollars are just $2.25 over spot per ounce. Backdated 1-ounce gold South African Krugerrand are just $49 over spot per ounce. And 10-ounce silver Nordic Mint bars are just $2.10 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend David Hunter, a contrarian macro strategist with 51 years on Wall Street. David, thank you so much for joining us today.
Yeah, hi Elijah. Thanks for having me. Great to see you again.
Fantastic. Well, it's great to have you back on today. I did want to discuss the main markets, the stock market, gold and silver, the bond markets, and also current events like the tariffs that Trump is going to be imposing here that seem to be rattling markets right now. A lot of people are calling on are saying that the stock market is topping and about to roll over. You have really talked about how there's been this 42-year bull market in stocks and it's coming to an end, but over the last couple of years you've continued to say it's not over yet, even when people have been calling the top. So where are we right now?
Yeah, we are. I think this is a great day to have this because I think we just saw the bottom in this correction. As you know, yesterday the tariffs were the main news and people panicked and you start hearing calls for the end of the bull market. You have been hearing that anyway, but I think we bottomed yesterday. We rallied off that bottom, came back, towards the end of the day, opened today up a little bit, and I think we're kind of bouncing around here. But I think we probably saw the bottom. The S&P came down right down to the 200-day moving average. NASDAQ slightly went through its, I think, 200-day. But what you're seeing here, I think, is the classic case of the market needing a rest. Came into this year pretty elevated, rallied a bit from there to new highs. And in the last month, most of February, I was saying, it looks like there's some work to be done before we move higher, and that's exactly what I think we've seen. We had basically a 6% correction in the S&P. I'm not sure what the number was on the NASDAQ, but probably close to a 10% correction. And, the Russell, which has lagged, got hit pretty hard, but it's fine too. The Dow got hit some. They all came down to levels I kind of expected. The SP went a little farther than I expected, but like I said, down to the 200-day. It looks to me like it's basically we're about to begin the final leg of this, as you say, 42. I think it'll end up being a 43-year secular bull market. Started in August of 1982. Dow back then was, I think, 780 at the bottom. So, the Dow yesterday got down to 42,400. It shows you how far we've come. And I think this last leg is going to be steeper than any of them we've seen so far. You tend to steepen as you move into a top. This is a huge top. Again, I've been at this for 51 years. I'm talking about a top of a market that for most of that 51 years, 42, 43 of them has been a bull market, secular bull market. That's about to end. That's a huge deal, and I don't think people are really recognizing that. And, of course, lots of people are trying to call a top here. They fought this market from October of 2022 on up and kind of capitulated, finally jumped in on the bull side in the last, 4, 5, 6 months. And then all of a sudden saw this thing start to roll over and got nervous again. It's amazing. I saw a sentiment indicator this morning that shows we're basically at the highs of bearish sentiment that we've been at over many years. So back to the levels of October 2022 or October 23, even back to the 2020 levels. To have a 6% correction in the S&P that gets people that nervous and that bearish is a huge statement, and it really supports my view that we're about to move into what I call a parabolic final stage. That means you can cover, an amazing amount of ground in just a few months. So from here, the S&P, my target is 7,500. That's 30% from here or thereabouts. The Dow, same thing, 55,000, about 30% up. The NASDAQ, 40%. And, my target there was 25,000. And my target on the Russell, which is the laggard, I think we're about to see that gain more speed. And you could see as much as a 60% appreciation. My target is 3,300, and that's basically 60% from yesterday's lows. So amazing kind of performance if we see anything like that. And I say it could happen in a few months. It might stretch out to 4, 5, or 6. I don't have any magic crystal ball that can tell me that. But any of the, even if it happened in 6 months, that'd be a huge run up. I actually think it'll happen faster than that, but I'm just cautioning people, don't get caught in thinking there has to be a precise date. This thing will go as long as it goes. The thing that will drive it, and I think, again, people underestimate what this means. We are looking at an economy that's slowing, and with, as you mentioned, the tariffs was the big issue yesterday. People were getting scared that this is the 1930s again, where, we got into a trade war with the world, and it ended up in a depression. We're not going to see a depression, but I think we are going to see the tariffs have some slowing effect. Certainly, Doge, which is going after government efficiency, lots of layoffs there. We're going to see all those things impact, and I think the economy is slowing. If it's not in recession now, it very well could be in recession sometime in the second quarter. So we're that close to, I think, a negative GDP. The Fed's, amazingly, their last meeting basically gave the impression if we're going to have any cuts this year, it might be 1. And the street bought that. So you had people talking 0 or 1, and the traders had it down to, I think, 1 cut for this year. We're back up to 3 cuts. I think, the numbers are starting to come in surprisingly weak, and so it's getting adjusted. I think you're going to see 3 and probably more cuts than that this year, as not even the interest rate cuts from the Fed that matter. That's going to drive the bond market lower. You're going to see much lower rates. Like I said before, I think you could see a 2.5% 10-year within the next 6 months or less. Probably the next 3 or 4 months even. And the Fed's going to have to start doing some QE once they recognize how weak things are. They don't recognize it yet. They're still talking about everything being pretty solid. That could change in a hurry, and I think might see it in the March meeting that they finally say we got to stop QT, and that is what will drive the small cap stocks once they and drive the market. Once investors start saying the Fed is really easing, and that we're in a new easing cycle, or that the easing cycle is going to continue and really ease with money, not just lower rates, that allows Wall Street, both buy and sell side, to start raising numbers for next year. And that's what I just saw Goldman's strategist on, and he was talking about he's lowered his earnings numbers for this year from 11%, the S&P earnings, from 11% increase to 9%. And that probably makes sense. The economy's slowing. He's saying next year it's 7%. what this will, if I'm right about the Fed ease, what that will allow the Wall Street to do is start increasing numbers. You'll see them go not from 7 to 9, but 7 to 15 or 7 to 20, because if they really believe the Fed's in gear and you're going to see a big easing cycle, you'll see numbers move up. And that's what will drive the stock market. So that's kind of a long-winded response on stocks, but it will also do things to other assets that are very bullish.
As you mentioned, right now, the narrative is pretty bearish. We're seeing the tariffs and all, but you're thinking the Fed will step in with QE before all of this before the crash happens?
Well, before a bust, I'm still calling for a global bust, which I think is bigger than 2008-9, at least financially. You'll see some ease, not nearly. The big ease will come in response to the bust, not before it. But I'm just saying that the Fed will start moving more aggressively to the easing side, both on rates and probably a little bit on QE. They don't want to. They have been very, Powell's been very outspoken about not wanting to go back to, big money printing, what we saw last cycle. So I don't expect them to move quickly in that way. But I'm just saying, if the street gets to the point of saying, hey, the Fed's we've got the wind at our back again, that's what's going to drive this last leg. Ultimately, I think the economy moves into recession, and like I said, could even be entering one now. And stocks can rally in a recession as long as the street believes that the recession's controlled and mild. Where you're going to run into the problems after the top is when the reality sets in that the Fed's been too tight for too long. They waited too long to ease. They're still reluctant to ease in terms of money. The government's downsizing is having an impact. Tariffs are having an impact. And they ultimately wake up and see that the economy is not only a mild recession, it's going to be a much deeper recession. And then move from there into a financial crisis, which causes a bust. So, but for the next, between now and summer, I think any weakness is going to be viewed as positive because it means the Fed could be on board.
And as for precious metals, I know you've been also very bullish on them. We've seen an increase along with the stock market with gold and silver over the last year or even longer than that. A huge gain last year, and this year started off very well for them. Where are gold and silver headed as the stock market continues its last leg up?
Yeah, I mean, silver's had a nice move today. Finally, it corrected this week.
Yep. And just to clarify for our viewers, we're recording this on Wednesday, March 5th. So
yes. Yep. Yeah. So, last week and earlier this week, we had silver down. But I want to remind people, because there's a lot of people who say silver's done nothing. Silver was at its bottom in 2020 was 12. In 2022, it got up to 18. It's now, 32 and a half, let's say. On its way to, I think next up is 36. After that, probably the mid 40s. And then from there, I'm calling for 75. And these are all numbers for this year. I'm not saying it's, 2 years from now. Silver's okay. It's lagged gold. It has been a little frustrating of late because it came into this year. Basically, it's been flat this year. Flat to down, probably flat to down a little bit, and the miners have been big laggards. So that frustrates investors. But again, it's kind of good timing today because I really think we are seeing the turnaround in both the metals and the miners, and that we basically bottomed out yesterday. So I do think, and by the way, gold has done obviously much better than that. Gold's at all-time highs or very near all-time highs. I have a target there of 3,400 this year, and I wouldn't be surprised if I have to raise that somewhere down the road. But for now, comfortable with 3,400. It's still $500 away, and it's had a nice run. I mean, it's moved up broke out at 2,100 a year ago or whenever, and you've had pretty much a steady gain all year, all the past year. And so I'm very bullish. Probably my convictions are very high on the stock market having a final big run, as well as the metals having a big run here.
So it seems like definitely the run's not over, but this year you're expecting kind of the final, or the really topping out here in a crash then in the stock market and precious metals?
Yeah, what I think we have, a global bust, as I define it, is something worse than what we've seen in post-World War II era. So in the last 80 years, it's not a depression. It's not going to last a decade. It's something that will be concentrated in a 12 to 18 month time frame. But it'll be worse than a typical recession, and it will come with a financial crisis that could be the worst in history, but certainly, comparable to 2008-9, and I think worse, is why I'm calling it a bust, meaning bank failures all around the world. We cleaned up our act some in the banking area in 2008-9. I don't know. We're probably going to be better off than some of the rest of the world banking wise, but it's going to be a big enough unwind around the world that it'll hit our backs very hard too. So that's coming. I think it probably starts sometime, maybe fourth quarter this year, maybe sooner, maybe later, but somewhere in there. And as I said, we'll be moving towards a bust in terms of recession before that. If I were guessing, I'd say the top is by this summer in the stock market, but I don't know that. And what I expect to follow that is the biggest bear market we've had in the post-World War II era. I'm calling for an 80% peak to trough decline in the indexes. And so if you get an 80% decline, or 75, 80, whatever it is, that means you're going to, almost everything in the market's going to get hit across the board. The only asset that I think really will hold up in the bust are treasuries, and treasuries of all maturities, both T-bills as well as long bond, and everything in between. And that's because you have a government guarantee there, and a guarantee from a government that people trust. So around the world, investors will flock to U.S. treasuries, because they don't know where else to go in terms of safety. So I expect the bond market to continue to rally while stocks are rolling over, while metals are rolling over, while most commodities are rolling over. That you could see a 0% 10-year rate at the bottom of the bust, or at the top of the bond market. And that could be late this year or early, first half of next year sometime. 0% 10 year. We got to 0.4, I think, in 2020, during the pandemic. This would be a new high in bonds or a new low in rates. Short rates probably go negative. And the reason for all that is because of, they're gonna be slow to catch on and slow to want to do it, because they're not going to want to do what they did last time. They're trying not to repeat the same mistake. But when you're faced with a crisis that's, free-falling financial system, you all of a sudden have to abandon whatever you think you should do, and they will be pouring money in at a rate we've never seen before. We could see the Fed balance sheet increase by 20 trillion. I mean, the Fed balance sheet got to 9 trillion a couple of years ago, last year, I guess, and early last year. And has shrunk down to maybe 7 now. Prior to, when we went into the 2008-9 decline, the Fed balance sheet was 875 billion. So we're now up to, got up to 9 trillion. I'm saying in this reaction to a bust, we could see 30 trillion in the balance sheet, an additional 20 plus. And every central bank around the world doing something similar, just because they don't have any other tool to deal with something that's basically free-falling, not just markets free-falling, actual banking system free-falling. And I could be wrong on that, but that's where I think we're headed. If we get something less than that, it's still going to be bad. But that's kind of what I've been saying this for a while, as you know, that the end of this would end that way. In terms of the precious metals, they'll get hit hard, Not as hard as equities. Probably silver could get hit very hard. If we go to 75 on silver this year, it could easily come back to where we are now or lower. If gold goes to 3,400, 3,500, it could come back to the breakout at 2,100. I wouldn't expect much below that. So, you do the numbers and they're not as big as the equity markets, but still big. Still don't want to suffer something like that. The difference between precious metals and equities is that post-bust, we'll have a cyclical bull market in equities, but they won't come close to the highs of this cycle. So, it's 7,500 on the S&P. Even if you go down 80% from 7,500, you're at 1,500. Even if you go up fourfold in a cyclical bull market, that only takes you back to 6,000. So you'll fall far short of the highs, the secular peak highs of this year. Silver and gold, on the other hand, silver's, I have a number at early next decade of 500, and gold maybe 20,000. So the next cycle is going to be very much a precious metal cycle, a commodity cycle. All the commodities will go through the roof simply because all that money printing, if they do indeed print 20 trillion, that will, with a couple-year lag, start an inflation cycle that's bigger than anything we've ever seen here. We got 21% T-bills and 21% inflation back in the early 80s. I think we could see that surpassed easily in the early 30s and 2030s. So, it's a very extreme forecast, but we're nearing the end of a super cycle that's been in existence since the Great Depression. And that's what happens at the end of super cycles, is everything goes to extremes. So I think that's where we're headed.
Definitely things going to extremes. You mentioned how short-term bond yields could even go negative. Is that because there could be issues in the banking system? Because that doesn't necessarily make a whole lot of sense to me why people would, be fine with a negative yield. Why not just keep their money, doing nothing in the bank? But I could see if there were concerns about the safety of the banking system that it might actually make sense.
Yeah, it's the safety of the banking system. It's also to do QE to expand balance sheet to the tune of 20 trillion, the Fed will be buying every treasury in sight, both long treasuries as well as short T-bills. They will buy everyone in sight, right? Because that's how you create money, is you buy the treasury holdings that the commercial banks have, the dealer banks have. You buy those and you deposit cash or deposit dollars in the banks. That's how you expand the money supply. So they'll be buying everything in sight. And also investors will be looking for the only thing, they'll be running to the treasuries as the only thing that has the government backing and government guarantee. So the demand will be through the roof. And even though the supply is going to be large, it's not going to be large enough to keep rates from going negative, I think. Now that's on short rates. On, like I said, the 10-year might get down to zero. This all would sound ludicrous, except we saw it in 2020. Like I said, we got down to a 0.4 10-year. So zero's not that far from there. And this is going to be far more dire than what we saw in the pandemic. So, corporate bonds will not follow treasuries. People have to understand, not all bonds are created the same. Treasuries have a government guarantee, a government backing, explicit, right? Agencies have implicit backings, but the treasuries have explicit backing of the U.S. government. The government has the printing press through the Fed. So that's why that's viewed differently. If you're in a corporate bond, if you're in a junk bond, you're in trouble in that kind of a scenario. But if you're in even a single A, you may be in trouble. If you're in a triple A, depends on how bad things really get, but people are going to pay for that government guarantee. So the spread between even AAA and treasuries is going to get quite wide, and very wide between treasuries and junk bonds, as we saw back in 2008-9. So that's why really the only game in town will be treasuries.
Now, moving forward here, you mentioned how really precious metals in this next cycle are going to be the big winners as opposed to the stock market. When it comes to the short-term gains we might see in the next couple months, we can't give financial advice, and really you're just giving a forecast here. I know you have mentioned in the past that it's really, I guess, this last leg of this 42 or 43 year bull market is really a risk on phase where it's high upside, but also, or maybe not even that high upside, but very big downside potential. So is there a cautionary warning to investors right now, or what is your perspective on people invested in, the stock markets or even gold and silver right now?
Yeah, you have to, those numbers I've been throwing around, you have to understand yourself. And on the one hand, we're looking at probably the fastest returns in a market over the next 3 to 6 months. If I'm right that the Russell can go up 50 or 60%, and the Nasdaq 40%, and the S&P maybe 30%, Dow 30%, to have all that happen in 3 or 4 or 5, 6 months, that's huge returns that you normally have to work hard to get over 3 years maybe. To have a double-digit gain 3 years in a row is pretty good for most investors, right? And so it's easy, like right now, for people to say, I don't care what's coming, what Trump's doing, or what's going to happen with the economy. I can't afford to lose money. I'm getting out now. I just caution people, people have to do what they're comfortable with and what their risk aversion tells them to do. But just caution and know yourself. If you get out now and the market runs 30, 40, 50%, I can almost guarantee you that the majority of investors will be pulled back in, because that's how psychology works. And investor psychology is one of the most powerful emotions, if not the most powerful emotion on earth. And if you're missing a market like that, somewhere along the line, you're going to jump back in and say, well, I don't know that it's going to top. Wall Street's telling me we got 3 years to run before this thing tops. So you're going to end up getting out now, missing the bulk of that move, getting in at the top or near the top, and then riding down, the market, maybe all the way, maybe halfway, whatever. Everybody will be different. But so I just tell people, know yourself, know what investor psychology is like. And I can't advise people whether they be in now or be out now, or, when to get out. But just understand, I lay out what I think is coming. I don't have a crystal ball to know for sure, but what I think is coming. And if it plays out very close to what I'm talking, just know there's a lot of short-term returns here just ahead. Even though most of Wall Street's telling you it's time to get out, they get it wrong. When the crowd is telling you something, often they get it wrong. Most of the time they get it wrong. And right now the bearishness is very high. On the other hand, what makes this such an unusual period is that within months, we're talking about the biggest bear, if I'm right, the biggest bear market we've had in 90 years. And you certainly don't want to just sit and say, I'm a buy and holder and ride through that. I mean, it'll be the rare investor who's going to be happy that they, listened to the buy and hold crowd and stayed put and then lost 80 or 90% of their portfolio, their wealth. So just know, yes, you got some big returns just ahead, but there's also some huge risks just over the hill, just over the mountain. And again, I'm giving you what I think. I've got a pretty good track record, but I'm not perfect and I can be wrong. So you have to kind of make that decision for yourself, but also just kind of understand. It's one of those things where you're running up the mountain and running down it. And if you don't understand how easily psychology can pull you back in, getting out too soon here could lead to even worse mistakes for you on the other side. And then the big story is beyond the bust and beyond that bear market, there is plenty of opportunity. It's just not going to be the same opportunities you saw in the last 15 years. Cycles change. Every cycle has different leadership. This last cycle has obviously been a very big tech cycle and, up until recently, a healthcare cycle. The next cycle is going to be a huge commodity cycle. The commodity producers, commodity stocks will lead the market, and that includes precious metals, but also copper, nickel, every commodity, steel, all the commodities I think are going to go through the roof because of that huge money that gets printed. What happened is you spent decades rationalizing down capacity, saying, well, we're, just-in-time inventories and, commodities are, we can manage them more efficiently now. So, and plus, there was a move against, for environmental reasons, against mining, against oil drilling, etc. So what we have now is commodity production that can, fits the demand cycle now. But if you get this ramped up demand through the roof in the second half of this decade and into early next, you can have huge demand and limited supply, and that's why prices can go through the roof. So, for example, copper, which is, say, $4 now, can go to 20 or higher. Natural gas, which is maybe $3, can go to who knows what, 40, 50, who knows, because demand will go through the roof. And you can say, well, there's a lot of supply as natural gas. And, that's crazy. You'll be amazed how fast that supply gets eaten up in a very monetarily driven, commodity driven, industrial driven cycle. And that's what I think we'll have second half of this decade.
And it will be quite interesting as we approach the top of this. If everything plays out as you're talking about, you've talked about before how really at the top of this coming blow off top, everyone will be jumping in. There will be a convincing narrative there that will make sense to a lot of people that, hey, we're off to the races even further, but that's right before the crash, obviously. So if people are interested in continuing to track this with you and keeping up to date with your insights and your forecasts, where can they find you?
Yeah, two ways. One, I am on X, Twitter, X, whatever you want to call it, every day. And my handle is at Dave, not David, at Dave H. Contrarian. I have recently gotten not a lot, but several people saying, I haven't seen you since February 12th. Well, where have you been? And I go, I've probably had hundreds of postings on X since then. You're missing it because your settings are only set for original posts. Most of my posts are replies to people's questions or replies to people's comments. So if you want to see my commentary, if you want to, get the benefit of my thinking, you have to go to your settings and make sure you're going to get notification for replies. I'm not sure exactly. I'm not an expert on that, but I think that's what people tell me is how you do it. So if you haven't seen me much of late, I was in Vermont skiing last week, but I did post a little bit last week, and mostly I've been posting a lot this week and the prior weeks before that. So if you're not seeing it, it's because you probably have settings set just to original posts. I do originals occasionally, and this is the way I choose to communicate. So people have to kind of get their settings right. I also put out a quarterly letter by subscription, which means there's a cost to it. If people are interested in knowing the details of that, all they have to do is just direct message me on X, and I will be glad to provide cost and other details.
Fantastic. Well, David, we really appreciate your time as always. We'll put a link in the description to your X page. Thank you so much, and you have a fantastic day. God bless. And any last thoughts you had?
We didn't talk about oil, but oil is one of those. I've been the bear on the street with oil. I've been calling for $60 for the last couple of years at least. And we're almost there. I mean, it got down to the low 60s once before, ran back up to 80, and we're on our way back down. I think it could certainly violate 60 on the way down. So, I think we'll see 60 in the next few months, probably in the 50s. In the bust, I think oil could get down to 30. The bigger story, though, is that the next cycle it will be part of that commodity run up. I'm calling for $500 oil. Crazy. If you go to 30 this year and then 500 by early next decade, that's a huge run. And people go, how can we afford that? It's not what we can afford. It's what the dynamics will do. So that will be another, oil and oil stocks will be a great investment vehicle in the next cycle, but a lousy one in this cycle for the balance of this cycle.
Fantastic. Well, David, really appreciate all your insights today. Thank you so much, and God bless.
Okay, thanks, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials while supplies last. Pre-1965 mixed junk silver is just $1.99 over spot per ounce. And pre-65 half dollars are just $2.25 over spot per ounce. Backdated 1 ounce gold South African Krugerrand are just $49 over spot per ounce. And 10 ounce silver Nordic Mint bars are just $2.10 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.